The Federal Reserve's recent 50 basis point cut is overwhelmingly viewed as a bullish signal for high yield stocks and really the stock market in general. And this has played out especially in the months leading up to the cut, as the market began to increasingly expect this cut and price it in. The high REIT space rallied, in particular sectors like real estate investment trusts and utilities and infrastructure businesses all experienced significant upside. And there are many reasons why this is. First of all, one of the biggest reasons why an interest rate cut is a good thing for high yield stocks is because high yield stocks are largely viewed as bond proxies because they pay out high yields that are quite stable and sustainable over long periods of time, or at least that's the expectation, especially companies like REITs that have contracted cash flows, utilities that have largely regulated cash flows. And so as interest rates come down, by comparison to what you can get on your cash being invested in bonds and other fixed income instruments, the yield offered by REITs and utilities becomes much more attractive on a relative basis. And so therefore, the market expects a lower dividend yield from those securities, and therefore their stock prices can move up higher. Another reason why Federal Reserve interest rate cut is bullish for high yield stocks is because many of these businesses are very capital intensive. REITs, they have to invest equity as well as debt capital to acquire new properties. Utilities invest aggressively in upgrading and improving their infrastructure to produce and distribute electricity and natural gas and water to their customers, etc. And so when their cost of capital goes down, they're able to invest at a higher spread, or at least invest in more deals, and therefore their growth rates accelerate. So that's another big positive. A third major tailwind from this interest rate cut is that it's also a boost to the economy because borrowing costs go down, and so consumers who are in debt have less interest payments, same with companies. Another thing is that lower interest rates means there's less of an incentive to save money in a bank account and spend that money, and so that's another stimulus to the economy. So all of these add up to be very positive things for high yield stocks. And of course, this starts a virtuous cycle because as the market becomes more bullish, their equity prices go up. That further reduces their cost of capital, which in turn fuels faster growth. And so it starts a virtuous cycle that can be very positive for high yield stocks. That being said, the interest rate cut that the Fed did, especially given that it was 50 basis points rather than 25 basis points, which many, including myself, thought was the actual more reasonable course of action, it's not all sunshine and roses for the high yield space. In this video, I'm going to discuss why. But before I get into that, if you could please give this video a like, that would greatly aid in its distribution, help me grow my channel. I'd greatly appreciate it. Thank you very much. Okay, so why is a 50 basis point interest rate cut not all sunshine and roses? Well, the first big reason is that, as Chairman Powell even alluded to at his press conference after the announcement of this 50 basis point rate cut, the decision to go with 50 basis points rather than 25 basis points was in part driven by the Fed being concerned about the other side of its dual mandate. Right, its dual mandate is to keep inflation low around their target level of 2% per year, while also trying to ensure that the economy has full employment, which is a very healthy, low amount of unemployment, but not so low that it's too tight and pushes inflation up. They're trying to keep inflation and employment, or really the health of the economy as well as the stability of the value of the dollar, in balance. And so recently, over the past year, unemployment has gradually risen. In fact, it's risen at a pretty steady pace. They recently had to downward revise to job creation earlier this year that further signaled negativity for the economy. Consumer confidence is down. Many U.S. leading trading partners like Europe and China and Japan are struggling economically in various ways. Consumer debt is at record levels, especially in credit card debt. Corporate debt is at very high levels. And so there are concerns about a slowing economy. And so the Fed felt like, these growing signals of potential recession, or at least very weak economic growth, are beginning to wage much more heavily, especially with the rising unemployment rate, compared to our lingering concerns about inflation. And so the Fed decided to cut rates more aggressively in order to try to bring those two things into balance. And this is a negative for high yield stocks because if the economy goes into recession, obviously that's not going to be a good thing for anyone, including some of the more economically sensitive high yield stocks. Another reason that's not wonderful is a whole sector, the business development company sector. They're very sensitive to short-term interest rates, and not in a good way either. For example, the past several years, as the Fed was hiking rates aggressively, BDCs actually significantly outperformed high-yield sectors like REITs and utilities because they invest in loans primarily to middle market businesses. These loans are floating rate and they're indexed to short-term interest rates. And so when the Fed was hiking rates aggressively in 2022 and 2023, they saw a massive tailwind to their net investment income. Their regular and their supplemental dividends grew accordingly and helping to fuel that massive outperformance. Now, when the Fed cuts rates, just as they just did and are likely to continue doing in the months and quarters and years to come, that's going to unwind a lot of that tailwind that they just enjoyed over the past few years. And so, again, expect their net investment income to come down. That's going to mean their supplemental dividends are probably going to go away entirely. And some may even have to cut their regular dividends, depending on how deep the cuts go and how the economy performs alongside that. So that's another negative to keep in mind if you're a high-yield investor that likes to frequent the BDC space. Another big negative potential headwind from this is that it could cause inflation to rebound because as interest rates cut, as we just said, it's going to increase spending because people are going to be incentivized to spend rather than to save or pay down debt. It's going to incentivize corporations to do the same thing. It's going to fuel growth on spending on growth by some of these REITs and utilities and infrastructure businesses. Now that's good because especially in the infrastructure space, we need a massive build out of our power generation system with the AI boom going on. But again, that's going to fuel that more inflationary spending. And so it could cause inflation to rebound. And if inflation rebounds, that's going to put us back to square one. And if the Fed then has to pivot and hike rates again, that's going to really cause a lot of disarray in the markets and may even be worse than the first time in terms of the headwinds for high yield stocks because it's going to cause the economy to start to lose confidence, the market to start losing confidence in the Fed's ability to achieve its dual mandate. And I think a sign of this concern even in the market already is evidenced by the fact that in the days following the Fed's cut, the long end of the curve, the 10-year Treasury, its yield actually increased after declining for several months. And this shows that there's not a perfect correlation between long-term interest rates and short-term interest rates. And so the market is concerned that, okay, yeah, the Fed is starting to uninvert the curve by cutting short-term interest rates, but there's still very real concerns about long-term inflation. And so that long end of the curve is starting to move up in anticipation of inflation potentially coming back, or at least the increased risk of it coming back. And so if long-term interest rates come back up, that's actually going to have a bigger impact on the valuation and financial performance of high-yield stocks than short-term. Because short-term interest rates, yes, they impact borrowing rates and other short-term things like savings and cash, but the long-term rate actually impacts high-yield stocks more because that's, as bond proxies, they're viewed more as substitutes for long-dated cash flows. And so they're compared more to the 10-year Treasury rate, the yield on things like REITs, as well as the fact that they tend to borrow with long-term debt. And so the long-term interest rate is going to affect their cost of borrowing, their cost of capital more. And so that's actually the real interest rate to watch, not just the Fed interest rate. So those are some things to keep in mind. With that in view, how are we positioning our portfolio? Well, before I get into that, if you could please subscribe to my channel, that would really help me grow it and help me reach a broader audience with my unique approach to dividend investing. Thank you very much. Okay, so the approach to our portfolio right now in light of this, I think one of the things we're really looking at, we like high yield stocks. We think there's still some attractive values in the space, and we do see some upside potential if the Fed is able to navigate a soft landing here and keep inflation in check. And there's a path to do that. But we like to hedge against the fact that they may very well not be able to do this. And so we're looking at defensive business models. We're looking at strong balance sheets. We're looking at well-covered dividends. And we're looking at business models that will be able to do okay and potentially even benefit from an elevated inflation scenario, or what many would call a stagflationary scenario, where the economy is weak, but inflation is still above the Fed's target rate. And so I think stocks like WP Carey, which it has its share of issues, but it has its CPI-linked rent escalators that make up the majority of its ABR, its rental income. And that means that if inflation remains elevated, so will its organic growth relative to its peers. But meanwhile, it has a very strong balance sheet with a BBB plus credit rating, has dealt with its near-term maturities quite well, has plenty of liquidity, has a fairly low cost of capital, especially due to its access to the European debt markets, and its long-dated triple net leases, well-diversified portfolio primarily in warehouse and industrial properties, as well as some storage and essential retail. Recently exited the office space quite well. That positions it well to weather a recession. Another set of companies we like are some infrastructure businesses like Brookfield Infrastructure Partners, Brookfield Renewable Partners. Those are also businesses that have long-dated, contracted, or regulated cash flows that make them very resistant to a recession. They have a BBB plus credit rating, each of them, just like WP Carey, and again, have that good liquidity, well-laddered debt maturities. In their case, they have very little recourse debt. Most of their debt is asset-level non-recourse. But at the same time, they have the vast majority of their cash flows in both cases are indexed to inflation, or at least have inflation protections on them. And so again, if we're in a stagflationary environment, I expect them to be outperformers with strong organic growth due to their inflation-linked contractual escalators, or at least inflation protectors on their regulated assets, as well as that stable cash flow generation, strong balance sheet that can see them through the period of economic weakness. A third sector I really like that's not been getting a lot of love lately, in fact, it's largely not participated in the recent high yield sector rally in recent months, is the midstream space. And I like this space because, again, they have those long dated contracted cash flows, or in some cases regulated. Again, it makes them nice and defensive. They pay out nice dividends or distributions depending on the business model. They have very strong balance sheets. Basically, all of them are investment grade, fully funding their growth with retained cash flows, so they're not having to go to the capital markets hat in hand and taking whatever price they're being given. So they're well insulated against interest rate hikes. But at the same time, they also have some inflation-linked escalators and or protections on their contracts and assets. So again, that space is also well positioned to do just fine in a stagflationary environment. And so those are places where I'm really allocating a lot of my capital right now. And finally, I mean, the BDC space is even a place that I would consider potentially allocating capital to. Again, you got to be careful. You want to be guarded against major interest rate cuts because it is a headwind. But if you can find some that have done a better job of not overexposing themselves to interest rate volatility, Federal Reserve rate hikes and cuts, and have defensively positioned portfolios, that could be a decent stagflation pick as well. So again, there are some opportunities in that space. Oaktree is one. Oaktree, especially lending, they have a very tight dividend. They very well could have to cut their dividend, and that's my only real caution with them, which it's a major one, but they have a very attractive dividend. It's over 13% yield right now. So there's some margin of safety there, even if they had to cut it some, but they've got an investment grade business model. I think they've got good skill at Oaktree. They've had some rough going recently, but they've got a long-term excellent track record. They have overwhelmingly majority exposure to first lien senior secured loans. That positions them well for a recession or economic weakness. And they've done one of the best jobs of any BDC out there of making themselves somewhat agnostic to where interest rates go. Yes, cuts will hurt them, but not nearly as much as a lot of their peers. So that's a potential interesting deep value play that if you can stomach the near-term volatility of a potential interest rate cut, could be one of the best BDC picks right now, actually, if you have that stomach for for a dividend cut. So yeah, hopefully this video was helpful to you. Again, if you liked it, if it provided value to you, if you could give it a like, subscribe to my channel. Let me know in the comments below what you think of this outlook and what high yield stocks you think are most opportunistic right now. Thank you very much. See you next time.